Hello everyone, welcome back. I got a lot of really good ones for you today, but first, I hope you had an awesome weekend and your week's off to a great start. Markets. We'll start with the bond market. The 10-year yield came up to 3.2% today. Nothing crazy, like 5, 6, 7 basis point move higher. If it had been like 10, 15, 20 basis points, that would have been freaky, but we didn't see anything like that. So bond market's kind of stabilizing following that run in the 10-year yield to 3.5%. Since then, a miraculous buyer has stepped in, presumably central banks. Bonds drove those yields back down, brought a lot of stability to the debt market over the last few days, which has kind of given other risk assets a little bit of room to breathe. Moving on to those other risk assets, the Dow, S&P, and NASDAQ barely moved today. Not really a whole lot going on in the stock market. Maybe a little bit of bargain hunting and bottom fishing following that pretty horrible route we've seen in the last few months. Oil did pop 2% today, so I'm keeping a close eye on the energy sector. I am starting to see, like, politicians and policymakers floating the idea of gas cards or gas holidays. I mean, if you have an inflation problem, you might want to think twice about solving that inflation problem with more inflation. It's not like the IRS is bringing in the tax revenue to just cut gas cards for everybody, right? And so not only will the IRS, ultimately be the ones to have to spend a bunch of money to roll these programs out, but they're also not bringing in the tax revenue to fund these programs to begin with. So if you're a tenant of MMT, Modern Monetary Theory, and UBI, Universal Basic Income, I understand the arguments to be made for sending money through the government and divvying it out to places in the economy where that money is just not making it. Like, I totally get it. But, you're fighting an inflation problem with more inflation. So that's kind of my problem with these federal gas holidays or gas cards. I also think that whatever revenue the IRS doesn't bring in off these gas taxes will just get eaten up by other players and producers in the space. And then that's just less money the IRS is bringing in, right? So kind of a wackadoo way to alleviate an inflation problem by adding more inflation to it. But hey, we'll have to see where that goes. So energy popped a little bit today. I mean, the big issue is we're also missing like half the world's supply, right? So as the world has been, more or less divided into two, we're trying to, fill all these gaps in supply for our energy needs, and that's driving up energy prices. And then you have that against the backdrop of like weakening currencies, right? So just a double whammy for inflated energy costs, and then to the rescue, more inflation to fix that problem, right? So we'll just have to see, but hey, I could totally be wrong. And regardless of me trashing on MMT and UBI, I do believe that regardless of left or right politics, we're moving in the direction of MMT and UBI. So if you want to get a beat on everybody, look up MMT, UBI, kind of give you an idea of where the government wants to go with policy in our economy. Bitcoin holding on to 20K. A lot of liquidity events in the crypto space that we've been talking about. They're still kind of working their way through the system. A lot of these leveraged players, people that borrowed money to participate in the bull run, they're being liquidated and destroyed right now. It's been a real nightmare for even a lot of the big institutional players, right? So nightmarish scenario for the crypto space continues to unfold, but hey, maybe you could make somebody else's nightmare your dream if you're optimistic and not levered and kind of thumbing through the shitcoin catalog, finding out which projects are not feasible and which could be incredibly constructive going forward. So not a buy or sell recommendation, but hey, it's a disaster zone. And if you showed up with a little bit of cash and some optimism, you might be surprised, because I do believe that there's premium to be had here in the crypto space, given just sentiment is so bad. I mean, you're so far from a speculative frothy bubble at this point. I mean, really, this is the ensuing crash. So I'm bullish on the crypto space, but hey, I also understand if yields and rates continue their march higher, could put even more pressure on the crypto space. So kind of keeping an eye on crypto. Bitcoin clinging on to that $20,000 support. I think it's an incredibly strong psychological support there at 20,000. So I'm bullish, but we'll just have to see. And ultimately, it will depend on what yields, rates, and the Fed does with policy. I think that'll be the starting point in deciding crypto's fate. So you want to see the Fed kind of flip dove. They've been really, really, really hawkish over the last 6 months, relatively speaking. That raising interest rates more than 50 basis points is like really, really, really hawkish in today's world with interest rates at 5,000-year lows. But I'm not in the camp that that trend is broken and ended. So I wouldn't be surprised to see overall rates and yields start to push lower, pushing risk assets like Bitcoin, the stock market higher, causing more inflation, right? Like, we're kind of in a situation now where the Fed is balancing the beast system and inflation and the dollar, meaning they want to protect their 401ks, pensions, Ponzi, right? All their assets that collateralize the entire system. Like, they want to keep a floor under those and keep that protected, but they also want to solve this inflation problem and help the consumer out at the grocery store and the pump, right? So squaring that is extremely difficult. It's kind of a tightrope that they're walking. I think they'll find a way to have their cake and eat it too, even if they have to essentially ease secretly. That's just kind of my thoughts on that. So real estate is kind of in a dip right now, I would say. We're seeing price tags get slashed $15,000, $25,000, depending on what part of town you're in, how frothy that market was. I don't see a real estate crash, though. I'm not calling this some 2007. You don't have those ARMs. You don't have those ninja loans. It's not a speculative bubble. I see real estate correcting because, mortgage rates are climbing, but I think the Fed's firmly in control of what happens in the debt market, and there's just no supply for housing prices to fall meaningfully. Like, we're in a very low growth regime. So even if the Fed tightens monetary conditions and prices a ton of potential buyers out of the market, I just don't see prices falling more than, like, say 25-30%, like a garden variety correction, recession kind of thing, bear market. A correction would be like 10%, right? So I think real estate could be in for a little bit more than just a simple 10-15% correction. They could be headed for like a little bear market. But I would say right at the line of that bear market, Fed's going to cry uncle, rates are going to come down, real estate's going to be rescued. And we're not in this speculative frenzy and froth over the last few years that we saw in 2007. People are able to pay really big down payments. And mortgage demand has been falling in recent months. It came up a little bit more or less recently, but year over year it's down. But again, even if there's falling demand for real estate, there's just not enough supply. So I think prices stay somewhat elevated. I'm not calling for a real estate crash, but I would say we are in a correction. So that's kind of your deal on real estate. Those mortgage rates at like 6, 7, 8%, that's, that is the danger zone, but the Fed knows this, okay? And the Fed knows that 12, 13% real, mortgage rates would just completely decimate the real estate market. And believe me, they don't want to cause that. These institutions exist to negate that. So real estate's probably in a correction, but nothing crazy. Stocks have been in a correction, but nothing crazy. Bitcoin's took a hell of a walloping, arguably, way too frothy. In a speculative frenzy in like the 60s, though. That asset class was sticking out like a sore thumb through 2020 and 2021. So not really even surprised to see that space get washed out. And now I'm more optimistic than ever. That's just kind of what I see going on. Ukraine's getting nastier, right? Like the war, and there's the total war, the war of attrition going on there. It's just so, I just feel, that's just horrible. And I'm worried now too, because I don't think the hot spot is going to be contained just to Ukraine and Russia. We have a situation unfolding in Kaliningrad now where this piece of sovereign Russian soil that's cut off from its motherland called Kaliningrad, well, Lithuania has cut off the railway that supplies them. So you're starting to see more like sanctions, economic war happen all along the eastern eastern edge of Europe. And I don't think Russia's going to be done at Ukraine. I think Russia has a shopping list of 15 or 16 former Soviet countries that they want to take back. They want their old neighborhood back. Some will go more willingly than others, but I'm just kind of watching additional hotspots form along that border between Eastern Europe and Russia. It's just kind of getting weird with those NATO countries in the EU kind of getting into an economic fight with Russia. We did hear today, like, oh, Russia's not going to be able to, Russia's basically going into some sort of honest default because they can't pay their bills. That's more of like a political thing than the reality. Russia has a lot of energy revenues to be made selling to other players. They've absorbed the sanctions surprisingly well. So just kind of a back and forth slugfest economically between Russia and the West, and I see this getting worse and expanding, and the conflict area spreading in the coming months and years, and not being more or less contained to Ukraine and Russia. So kind of watching that. G7's meeting today, I'm sure their focus is on Russia and energy policy for Europe. They, on the one hand, they want to starve Russia of oil revenues by not buying energy from them. But on the other hand, this energy is going to have to come from somewhere, right? So that's causing prices to go up a lot. And against the backdrop of their currencies also weakening, right? So it's kind of a double whammy for energy prices. Just absolute craziness for energy. And then, right, we talked about the gas taxes, the gas holidays, and how that, that's akin to putting a Band-Aid on a gunshot wound, in my opinion, but we'll just have to see. Maybe the Eurozone will shift its energy policy back to dirty, right? So like start selling more coal, maybe reinvesting in some of these oil projects that originally they said, hey, it takes 10 years to get an ROI on an oil project, and all these G7 leaders are saying they want to be off fossil fuels by 2030, and it's 2020 now. So by the time I get an ROI, we're not even going to be using this stuff. So a lot of these big players and institutions divested from dirty energy sources over the last few years. But hey, now that we're in a state of war, maybe they're going to have to shift back. I do see them continuing to pursue renewables and green energy. We need a more diverse energy portfolio anyway. So we'll continue on with that, but we're going to have to bring dirty energy sources along for the ride if the situation between Russia and the West continues to deteriorate, right? So keep an eye on shifts in energy policy. Look for the ECB and the Fed to try to have their cake and eat it too. So try to find a way to alleviate inflation for their people, but somehow tighten their monetary conditions. What a mess, right? So just keep an eye on those heavy hitters, big players at the table, those big institutions like the Fed and ECB, and what their monetary policy is going to be, and then the G7 leaders and what they're saying for energy policy and what they want to see happen. And then just kind of square that up with the reality of the war kind of spreading along that border between Europe and Russia. So weird, crazy times, but otherwise a pretty boring summer doldrum day, right? Like low volume, low liquidity, nothing too crazy in the market. So just kind of keep an eye on everything. I don't think inflation personally is going to get a whole lot worse over the summer, but I don't think it's going to get much better either. This is just kind of typical of summers. We're just kind of slogging through. Growth is extremely low, but that doesn't necessarily equate to deflation, right? Because whatever holes in growth we have, we'll fill with fake money, MMT, UBI, price controls, whatever we got to do. So just keeping an eye on the big picture, keeping an eye on the markets, the economy. I'd say the economy is in such a weird spot right now because we have a labor market where for every one person looking for a job, there's 2 job openings. But problem is these companies just don't have the profit margins to keep up with this inflation, all right, and this cost of capital, and it's just really jamming things up. So for every 20% risk assets go up, you're getting like employees are getting like a 5 or 6% pay raise, that's the road to serfdom. So if you're working out there, I know it's hard, but try to do the cost of capital. And if you're wondering what that is, we'll average out the S&P 500 over a few years, average out real estate over a few years, average out gold, average out Bitcoin, energy. That look at what the prices of those have done over the last couple years, and then maybe extrapolate a percentage average increase and then apply that to your wage. So if those are going up 20% a year on average, your wage is going up 5 or 6, hey, every year you're getting 15% poorer, right? So watch yourself out there. Don't be fooled. There's tons of jobs out there, but most of them aren't paying diddly, and you're going to want to do your best to keep up with the cost of capital. And that goes for the entrepreneurs and the businessman too, right? Like, do you think he wants to borrow $100,000 and then work 80 hours a week to make 20% on that? Or do you think he wants to borrow $100,000, not work, put it into oil, Bitcoin, the S&P 500, and real estate, and just, collect his 20, 30, 40% off of not working, right? So the opportunity cost, thanks to inflation, these janky markets, the opportunity costs are getting all janked up, right? All these small business owners and entrepreneurs are just like, look, if I got a mountain of money, I'd rather do it with, I'd rather buy the market and do no work than go out and try to beat the market. When the reality is, like, let's say I'm a general contractor, I'm going to make 30% profit margin and then lose 20% of that to inflation. So, and then the alternative could be I just put in Bitcoin and never get out of the pool, right? Never get out of the jacuzzi and check your phone. So, weird economic and political environment we're in, really janky times. But hey, we're just going to kind of get through this summer and just kind of see where we go from there, right? Just muddling on through, keeping an eye on those asset classes, those superpowers, and just kind of seeing how the cards fall. Really all I got for you for now, but I'm sure something, next crazy thing's about to happen, right? So I'll be there for that, and we'll just keep pushing on through. Hope you have a great evening, and till next time.